why are oil prices continuing to rise? A sharp rise in energy prices could be problematic for economies already reeling from the effects of high inflation. The oil price shock couldn't have come at a worse time for the global economy, which was already reeling from high inflation. Brent crude, a global benchmark, was trading at around $114 per barrel on March 3, after reaching a 10-year high the day earlier. As Russian forces continued to bomb Ukrainian cities, concerns about the disruption of power supplies to global markets are growing. According to a J.P. Morgan analysis of the situation, crude oil could reach $185 per barrel by the end of the year if Russia, the world's third-largest oil producer, continues to face transportation issues. Financial sanctions have been imposed on Russian banks and corporations by the United States, Canada, and European Union member nations. Despite the fact that the sanctions do not immediately target Russian oil and gasoline infrastructure, they have frightened customers. Around 66% of Russian oil is struggling to find takers because transport companies and merchants are afraid of being caught in the sanctions trap. Consumers are so concerned that they are unwilling to trade in Russian oil, even if it is offered at a steep discount, according to Bloomberg. This does not bode well for central bankers who have attempted to tame excessive inflation in a number of developing and developed economies. According to the World Financial Institution, excessive inflation has already become a worldwide issue. A rise in oil prices will put pressure on the currencies of countries that rely on imports of energy. With 5 million barrels per day, Russia is the world's second-largest crude oil exporter, trailing only Saudi Arabia. It also supplies approximately 2.8 million barrels per day of petroleum products, including gasoline, to global markets. Russia accounts for 5% of global oil supply. This may appear insignificant, but in a healthy market, each barrel of oil counts, and any disruption can have a significant impact on the price of oil. Russian oil has the potential to find buyers in China and India, two massive markets. However, power sale proceeds fund 36% of Moscow's national budget, and a prolonged disruption could cause problems for President Vladimir Putin. Some politicians in the United States and elsewhere are calling for direct action to halt the flow of Russian oil and gasoline. However, such a transfer does not benefit either the US or the EU because it can drive the value even higher while harming their own populations. In the United States, inflation is already at a 40-year high. The sanctions are also intended to harm Russia's oil industry in the long run. The United States and the European Union have prohibited the export of specific refining expertise to Russia, which may face difficulties in producing refined goods such as gasoline if it is unable to improve its refineries. A cascading effect. The EU imports roughly 40% of its pure gasoline requirements from Russia. Until now, Gazprom, Russia's state-owned oil and gas company, has not reduced the availability of gasoline, which is delivered via pipelines to countries such as Poland and Germany. This hasn't stopped the price of pure gasoline from skyrocketing. On Thursday, spot costs on the Dutch tidal switch facility, TTF, hub, a European gasoline value benchmark, hit a record $221 per megawatt-hour. Despite the fact that the US liquid natural gas, LNG, firms have increased supply to the EU market in recent months, it is nowhere near replacing Russian gasoline. Any reduction in Russian supplies will benefit LNG exporters in the United States, which has emerged as the leading producer of pure gasoline as a result of newer drilling methods that extract hydrocarbons from difficult-to-crack shale formations. After a long hunch, energy costs began to rise final year as demand from factories and businesses increased after pandemic-induced restrictions were lifted. Fears that the conflict will lead to shortages have caused prices for a variety of commodities, ranging from coal to wheat, to skyrocket. In terms of oil, there is optimism that a breakthrough in the Iran nuclear deal will pave the way for a major oil producer to ship additional supplies to the market.